Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Stephen Hester, editor at our corporate affiliate Wide Moat Research.
Stephen is awesome. He knows all about options trading for income, and he knows all about high yield securities. Two great areas. I know a lot of people are concerned with income, as they should be, and this is the guy to talk to. And let's do that now. Let's talk with Stephen Hester. Let's do it right now. Stephen, welcome to the show. Glad you could be here.
Thank you, Dan.
You bet. Corey and I are going to pepper you with some questions for a while here this morning. And let's start out, though, with the ultimate question for our listener who is saying, Stephen is a new guest, haven't seen him before. Maybe you could just tell him a little bit about what you're doing now and how you got there, a little bit about your background.
Yeah, happy to. It's been a fun adventure. As of right now, I manage two of the three back-end products for Wide Moat Research. So my partner, Brad Thomas, he's definitely the figurehead. I go on camera every once in a while, so a few people have probably seen me, but he's definitely the star of the show. But I run an option service, not a speculative. In fact, I'd call it the opposite, believe it or not. We'll probably get into that maybe later. But yeah, I have an option service and then a high yield service where I try my best to have the you can have your cake and eat it too. We know there's no real one of those, right? It's a matter of how far you can push in that direction. So yeah, it's two interesting ways to get income that I think the average retail investor, and I think understandably so, has some hesitancy around, right? And so as much as I try to give them really good investing opportunities, it's also about teaching them. So long after they're reading my stuff, they'll still have those skills and that knowledge. And we've been at market-wise in one form or another for probably four going on maybe 5 years. So a little bit of time, less than some other people on the podcast, but we've been here for a little bit. And prior to that,
Mostly Dan.
yeah, exactly. Yeah, Dan's we're talking multiples today. There would be the first multiple of the conversation.
Yeah.
But both Brad and I wrote a lot on Seeking Alpha, and that's how we met. And I was a little guy compared to Brad. But as we'll probably also talk about a little bit today, I specialized in alternative investments. So real estate, private credit in the case of the public markets, right? Business development companies. And then also because of my hedge fund background and just most of my career, and still a little bit to this day, is on complex investment due diligence. And so that lets me take, like, what is this preferred or this little goofy thing that yields too good to be true? How do I understand what the risks are, right? How do I kind of peel back the layers of the onion and figure this out? And my skill set, frankly, is better in that area. And so I kind of apply that institutional skill set I developed over the past 20 years or so to help subscribers today in more abstract, asset classes like interesting parts of high yield options, etc.
All right. That's cool. There's a lot going on here, which I love because I love tearing into, complex situations.
I have a question about one of these high yield areas later, but we can get into some other stuff first. But yeah, for sure.
Yeah, we have. I have a question just to start it from the top down a little bit here. I'll phrase the question in the simplest, most primitive terms possible, and Stephen, you just go with it wherever it goes.
Sure.
So in the most primitive terms possible, real estate lending is a long-term proposition, right? Mortgage loans are a long-term proposition,
right?
Now the Federal Reserve likes to manipulate the shorter end of the yield curve.
They certainly do.
They certainly do. And sometimes, as we were talking just before we hit the record button, sometimes the longer end of the curve, 10 years and out, doesn't really like it very much, which is to say, for our listeners' sake, sometimes the Fed cuts rates on the short end and the longer term rates go up, not down. presumably this dynamic is important to a fellow in your niche.
Yeah. So first I'll be the first to say that it is pretty hard for anyone to figure out how all these levers work. So starting with a little bit of humility there, I try to focus on what I can determine is true. I definitely am probably about as good as anyone in kind of predicting the future, et cetera. But even knowing that you don't know something, right, is still very valuable. Maybe that means you go through a floating rate option, right, or something if you just don't know. But in terms of the interest rates in the Fed, it's kind of an interesting dynamic, right? So the Federal Reserve does not have, I won't say power because that's probably not the right word for it. It doesn't have as direct influence over interest rates as people think. And it's not that they're really wrong or they didn't observe something correctly. It's that in many times in the past, when they have pulled their one lever, it's it's gone through the whole credit markets. So it
Mm-hmm.
certainly looks like it, right? Like they pulled the lever, they put
Yeah.
interest rates to zero, and it
Yeah.
worked, right, throughout the whole yield curve, meaning 5-year bonds, 10-year bonds, 30-year mortgages all went down.
Right.
But they really only have control over the front curve because they were dealing with banks in a very particular way,
Mm-hmm.
on kind of like short-term credit. Um, Interestingly, and I think we're literally seeing this today, is if you push interest rates low and that through a ripple effect increases expectations for inflation, well, then a 10-year or 15-year, uh, you know, obligation, right? They're going
Mm-hmm.
to price that higher
Yeah.
because you're sitting over here like, well, shoot, if inflation goes back up to peak, I'm only making 100 basis point spread, 1 point spread. That's not very economic, right? What's the point of that? Well,
Mm-hmm.
I'm getting, inflation expectations are going up. Federal Reserve is kind of throttling the early part of the interest rate kind of yield curve. I'm not trying to use fancy language. Just think of the yield curve as just interest rates today on like a 6 month CD versus a 10 or 20, right? That's all that curve means. If they
Mm-hmm.
make it too cheap in the beginning, that absolutely all things equal, causes inflation. And people who have long term fixed rate, debt, if you're buying it, it's going to make you more nervous about where inflation is going to be in 5 years or 10 years. And so I think literally I saw new data today, Dan, on mortgage rates popping up a little. And I've got a home I'm trying to sell. And so I'm looking at
Yeah.
it through like two lenses here, from the investment one and the, great, interest rates are going up over there. So it's definitely a challenge. That to just give one more point there, from you asked me about kind of an investment perspective, when you're looking at, um, let's use real estate investment trust. That's the publicly traded real estate vehicle for most people. Uh,
Mm-hmm.
it isn't as, I think, as simple as you might think, including some of the CEOs of those firms, to do what we'll call the right approach, because some of the best REITs stacked their,
Yeah.
they made their debt pretty short term,
Mm-hmm.
which means it rolled over quickly and they got exposed to interest rates sooner. And now they're looking around and they're like, well, long-term debt isn't cheap either, and they're kind of stuck.
Mm-hmm.
So at least you can look at, the balance sheet of the company, and it's not unique to Reese necessarily, but any long-term debt, and just think, okay, is this actually a prudent move? What risk does this create for the firm? And it also helps explain sometimes, especially with real estate, whenever rates do move unexpectedly, you'll often look at your portfolio and be like, man, what the heck is going on with this stock or that stock? And oftentimes the answer lies in, they structured their finances in like a way hoping for this, and it looks like we're actually going in the other direction. So it can be pretty useful.
All right. Um, I, I I like the fact that you started off talking about humility and the inability to predict. That's I just want our listeners to know that's how you know you're sort of that's one of the things that tells you you're talking to the right guy.
Well,
Um,
hopefully.
we, yeah. Well, one of them. Don't worry. We got
Yeah,
more to talk about. Yeah. But it's really important because people can't predict that kind of stuff, and it's the job becomes management and strategy and not prediction.
that's
And
right.
I think too many investors I hammer on this point even though it may seem a little laborious because I know for a fact that a lot of investors, individuals who are managing their own accounts, who aren't necessarily financial professionals, they get an idea about being able to predict things kind of stuck in their heads early on. Um, I think a lot of people start out with that idea. So I just, anytime I can disabuse people of that idea, I take the time to do it. It's that important to us, I think. So let's talk about, let's go at one of these buckets that you play in.
Sure.
How about options? I love the fact that you said that these aren't speculative positions. And I assume you're like, selling options and selling spreads and things for income. And what are your? I'm really curious to know, because I do this all the time myself. I'm curious
Right.
to know, like, what your favorite strategies are, and how you think about it from the top down, and then how you go about it from the bottom up.
Yeah. No, happy to. So when I traded, it wasn't for long, but I traded for a few years, and I was right out of UT Austin. Where I still live in Austin and Mexico City, but I'm in Austin right now. And when I was here, I was finishing up undergrad and was working at a hedge fund. And the reason I bring that up is because I was not very good at trading what the other guys traded. They were doing like momentum. They were doing technicals, not in the way most people understand it, but more like order flow analysis using really
Hmm.
advanced software.
Yep.
And they were pretty good at that, but um, I was mediocre at best. I was better at risk management and better at doing due diligence. No surprise, at this point, whatever, 15, 20 years later. What I found was that illiquid securities have like a structural benefit, meaning if you play it correctly, illiquid securities can benefit people who understand them well. And the flip side's true too. If you don't know what you're doing, illiquid securities charge you a tax.
Yeah.
Well, I love collecting that tax, and it takes a lot of strategy. It takes some experience for sure. But options compared to equities, at least, one of the benefits for me is they're illiquid. And what that means is it's not unusual at all that, I like selling put options to answer one of your questions directly. Well, on a put option, let's say it's a given contract, doesn't really matter. And maybe
Hmm.
the premium is $3. And then some news comes out, the market moves a little. It's not unusual at all for that premium to go to $5.
Hmm.
Well, that's a dramatic increase, right? 75 whatever percent increase, pretty remarkable. Um, in the equity markets, that doesn't happen very often, right? I mean, you have to go really aggressive into crypto or something with leverage or whatever. And the point being is, if you're patient, like on my back end service, we do one trade a month. So I have a kind of a big framework that, as it's getting close to when I want to make that publication, it's narrowing down the opportunity set. And typically, we'll say, like, oh, wow, this is interesting. I have tools that I use, and the premium is currently 50% more than it should be, all things equal. And if you guys want to go through what that means, practically speaking, I can do that. So not only uh, is the put option attractive, but since it's illiquid, the price moves very quickly. And if you're using limit orders and you're very disciplined, other people's kind of aggressive behavior or knee-jerk reactions actually transfer money into your account without not a lot of stuff in between. It really
Hmm.
does work. And the other component that I think is important is that when you're selling put options on quality companies that you want to own, and that's a very important statement. If you remove any of those pieces, it doesn't work. But if it's high quality and it's on a stock you want to own, then you're actually selling insurance. Is what you're really doing, and you're collecting those premiums. And sometimes an event happens, and you have to pay, in the sense you have to buy the stock, and
Hmm.
that's okay as long as it's a good asset. But the return profile, both for me individually and for the service, is very much actually like selling insurance, where you're being careful on what you underwrite. Right, you're
Hmm.
not selling insurance on anything. Like, there's probably some teenager with a new Mustang out there. Are you going to sell them insurance for $10 a month? Well, it sounds laughable, right? Like, that's crazy. Well, what
Yeah.
if it was 2,000 a month? Okay, well, I don't know, right? Even though those numbers are vague, we
Hmm.
instinctively realize, oh, wait a second, that actually sounds interesting. So a
Yeah.
lot of what I do behind the scenes is I run the math and do a lot of fundamental analysis. Is actually the main focus I have on the underlying company, not on the option. Kind of comes last, because if the company isn't rock solid and I don't understand what the key risks are, then you're going to get a nasty surprise when you sell a put option on something you don't understand. and it backfires because that we can talk about it, but that will happen a lot. If you're not careful, actually. So
Right.
that's kind of it in a nutshell. But that's my favorite strategy and kind of why it works.
So selling puts on really high quality companies, mostly in the real estate sector, or just no, or just
Yeah, not mostly in the real estate sector.
okay.
Probably less than 10%. It's
Okay.
Yeah, it's pretty sector agnostic. I have done it definitely on a few REITs, but yeah, there's certain reasons why REIT premiums generally aren't as good as some other industries. But yeah, I
Hmm.
go where the market tells me. I did a decent amount of AI related companies, which normally wouldn't fit my profile, but some of them got very cash rich and the growth rates were so high. I got comfortable with them and actually had some of our, and this isn't a sales thing, it's more of an indication of how the market works, but it ended up being some of our best trades because the volatility around some of those names was so high that the risk
Right.
adjusted made sense, right? That volatility can help.
Right.
Yeah. And right,
Steve.
if you do it like you're saying, right, consistently,
Yep.
you can do it consistently, right? Over time. If when people are seeking income, like this is something you can do over and over and over again, right?
This is it. Yeah, that's a good question, Corey. Because yeah, like I do them once a month, and people might think, well, yeah, but he works very hard. It's his job to find the trade. Is it realistic for me? And you probably won't maybe find the best trade all the time, but I think a pretty practical way for listeners who are they're in the mix, right? They're in the market, and they probably have maybe a watch list. I think a lot of people have that, right? Maybe it's 10 or 15 companies. Some of them are new, and some of them are maybe like for me with Caterpillar, for example. I've sold puts and invested in Caterpillar. I don't know how many times, like dozens of times, and I have like almost 100% win rate. And that's mostly luck, by the way, but it just worked out well. So that's on my little list, right? That I'm kind of looking at. And once the stock kind of comes down to where you almost want to buy it, that's a really good indication that you may want to sell a put option on it because you're going to get, let's say it's Caterpillar 200, which is the old days, but say it's Caterpillar 200, and you're like, man, I would really like to buy it, between 180 and 190. I'm disciplined. I'm going to be patient. Well, one option you can do, no pun intended, is sell a 200 strike call option, collect, a good premium. Maybe it's $15, right? Wouldn't be unusual in that circumstance. And then there's only two options here. You're either going to own the stock at 200, but at a lower cost basis, right? Because you collected that nice premium, about $15 a share in this hypothetical, or you don't, and you just collect the premium. Those are the only two possible outcomes. Now, that doesn't mean that Caterpillar can't go to 150, right? It doesn't. That could definitely happen. There's of course risk. However, psychologically, I like to think in probability terms. If you were going to buy it anyways at 185, then you were going to buy it anyways at 185. Whether you sold a put option or not is irrelevant, right? It doesn't make any sense, even if emotionally it's a little painful when it goes down. So that's a really good way. When I have like colleagues and stuff that are asking kind of how to get into it, a great way is what's your favorite low dollar stock? That way the capital commitment's low. And let's say Ford is cheap. Ford was beaten up for years. It would go down to $10 a share and kind of rebound. And I'd say, well, if you're thinking about buying some Ford, the premiums, by the way, in Ford were excellent for a long time. It's kind of recovered now, but for years the premiums were pretty elevated, and that was a great way for a minimum amount of capital that you could sell that option. Typically, what would happen is you could get, just to give a concrete example of why you might do this, you could collect potentially maybe 1.5 years of Ford's dividend, which is a pretty significant dividend, right? In maybe 60 days. Well, if you're an income investor, this makes sense as long as you do it correctly. You got to be safe about it.
Right. That's awesome. Yeah.
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 That's a
I
great
love
way.
that.
That's a
That's
good
great advice.
perspective on it. Yeah.
Yeah.
Mhm.
Because it takes that strategy, like if you almost want to buy the stock, it's a great time to sell a put option. It's a great way to think of it because it just takes the psychology. It's like a psychological cheat. It's like you
Mhm.
just take the decision making out of it. You let the market decide for you. I guess it. There's always that aha moment, like when those sorts what you're describing to me is like when that when some decision can be made for you that just benefits you both ways. It's refreshing. So yeah,
Right.
Yeah, it's a good
glad
point,
you
and it
described it that way. Yeah.
it helps you avoid what I really hype on, and the reason, again, I like examples. in my, let's say it's an 8-page analysis that I send out to subscribers, right? 7 of those is on the fundamentals of the company, not on how much money you're going to make, or theoretically, right, on the option, because
Right.
you don't need to know anything about the option if it works correctly. You're just going to get money the day you sell the contract, and then
Hmm.
2 months later you're going to think you're a genius, or whatever.
Yeah.
But that is not how it always works. And so the way you described it, Corey, I think is so valuable, is because the the temptation to sell a super rich premium on like a GameStop, or whatever, it
Right.
won't
Right.
happen
Yeah.
because you know that your style is maybe not to do that. And instead you stick to companies you already know. And I think that's like the major risk factor doing this, because it's tempting. We have to be honest about that. If you sell put options on a couple good companies, and you look up one in the news that's being sued, or some horrendous problem is happening, and yeah, the put premium will be high, but it will be high for a
Yeah.
reason.
Yeah, that falls under the general category of chasing yield. And I was talking about too the framing the option income in terms of the dividend yield is it's something option traders do that our listeners might not have known. Just put it
Hmm.
that way.
Yep.
Uh, so you were talking about how where about the premium being where it ought to be, before, and I wanted to get back to that about the premium being the level where it ought to be, or at a given time, maybe it's much higher than it ought to be, and you said, well, we can talk about that later.
Yep.
How do we know ought to be? How do we know what it ought to be?
So there's a bullet down to kind of two factors. One is relative to other stuff. So that's one metric. So if, let's
Hmm.
say it's Ford, if we stick with that example, GM financially is actually not that far off Ford in many ways. Neither of them are A plus rated, et cetera. They have
Hmm.
pretty similar exposures. They make most of their money off trucks and SUVs. We can go on. So you can
Hmm.
look around premiums, and that's kind of the, the simple market comp looking around. And the second one is relative to the company's fundamentals. And one of the most important aspects of that is, um, I personally, and I don't always succeed in this, but I personally try to define really attractive opportunities as, if you think of a stock price that's moving, right? But
Hmm.
instead of looking at the stock price, it's a chart of the valuation, and it varies by company.
Right.
It's not
Yep.
always this simple, but for a standard company, it's a C corp. You can do it off net income. Usually, that still requires a little massaging, right? Because of M&A, and you know, earnings is an accounting number more than a financial number. So some companies, it's one and the same. Like the earnings is just how much money the company made. It's that simple. Other times it's not. But on companies that are steady, which long-term dividend paying companies generally are, right? Almost by definition, their earnings are reflective of what the company's doing. So that's an important caveat. But whatever the earnings ratio is, if you look at it as a chart, it's going up and down. If it's in the bottom 10% of where it normally, historically trades, and it doesn't have some like cataclysmic problems, that gets my attention, right? And by definition, 10% of the time it's going to trade down there. It doesn't necessarily mean things wrong. Sometimes it does. Um, if your put contract, if the strike price is, call it, in the bottom quarter of the valuation of the firm, you're probably going to be okay, right? Even if you put the stock, the company's high quality, you paid a reasonable price, you're probably going to be okay. I assume every put option will be put to stock. In fact, I actually welcome it because the return should be better, actually, right? If we really did find an undervalued gem, it usually will work out even better over time. So it's the
Okay.
valuation relative to what price you would own it, just like buying the stock. We look at it the same way. And
Hmm.
then really looking at the risks, like really spending time looking at the risks facing the company, because the probability that it's trading that cheap and there isn't some kind of problems going on, at least in the
Hmm.
industry or with the company, is low. And so a lot of my time, probably over 50%, is just going through those risks and trying to get a good understanding. And the
Right.
market is, uh, I think it's rarely wrong long term. And who am I to say, frankly, the market's right or wrong? But just based on where the stock goes, right? But it's wrong all the time in the short term, which makes investing difficult if you focus only in the short term. And so
Hmm.
there's tons of cases where an earnings miss happens, and then you read through it and they raise guidance. So they're actually anticipating better results over the next 12 months. But a slight miss causes every Wall Street analyst, to hit a massive sell order. The stock drops 10%. The put option premium goes up. Assuming it was that simple, that could be like a good setup when I'm talking about kind of analyzing the fundamentals.
It fascinates me. I think it's really important to note that you talk like a long-term stock buyer. You talk like a long guy who's buying stocks and holding them for the long term. But you're doing that analysis and you're taking these, much shorter term option positions. And you're talking like you said, 7 of the 8 pages is the fundamentals of the company, as though you're viewing the stock as ownership in the company. You're not just, trying to flip a trade for some technical reason or something. That is to me, that's really cool, because I've made my living for 25 years. Porter hired me 25 in September of 2000. We were talking about, how long people have been around the company. And that whole time, all I've done is pick stocks. I haven't done any options, trading not in a newsletter, but I've done it in my own account. And it's almost the identical process of assessing the value of the company and assessing the fundamentals of the company and assessing the risk in the sort of detailed manner that you say. But except one little difference: I want to hold the stock for 10 years. You want to trade an option for 2 months. That's fascinating to me.
Yeah, it's interesting, and this kind of it aligns with a core thesis I have, which whether you're even doing like hedge fund due diligence, like or private equity, or these things that all seem like very different from each other, very abstract. For me, at least, even if it's a short-term options trade or like a 10-year hold on a really good tech play, whatever, the actual underwriting to me shouldn't change a ton, because the truth is, if we're being very honest, like nobody predicts the Great Recession very well, and even if they did, they don't know how it's going to happen exactly, right? It's just too many random human events that are going to be involved. So the point is, if I can do a reasonably good job of protecting the downside by looking very closely at it, then in the event, which it's going to happen, we've definitely been put stocks, and the win rate's pretty good on those. Not every one, but pretty good. Then I'll be minimizing losses, where instead of a 50% loss, maybe it's 5 or 10% because they've missed earnings. And it's like, you know what, this company doesn't earn my money anymore. The fundamentals that we reviewed, the trajectory is not very good anymore. And then if there is a crash, which is always coming, right? We don't know which sector, we don't know how it's going to work exactly. You want to be in a company you understand well, that you can either make a decision, hey, it's time to jump ship and go, move out, allocate our capital somewhere else, or hey, I'm not going to panic on a drawdown, right? We're all susceptible to that, and the more kind of retail focused you are, I think that it's just human nature, tends to override it. And the more confident you are in what you own, the less susceptible you will be to a panic move that you regret, right? I mean, look at COVID. That's probably the most extreme example.
That's right.
But yeah, that helps me in my newsletter customers, right? Is they're like, you know what? I know this company. I'm not terrified. I'm not going to sell just because we're put to stock, because most of the time it's just market volatility.
Yep. Yeah, that people wonder, how do you know that you want to, the stock's down 20 or 25%? How do you know to keep hanging on to it? Like, well, remember that 8 to 10 pages of stuff I sent you like 2 months ago? It's all that.
That hasn't changed. Yeah.
Yeah. And if it has, that's okay too. We'll acknowledge
that,
and we can move on.
Yeah.
But yeah, I mean, this is kind of a funny way to look at it, but I think it can help people psychologically. Pull up whatever company you want. The chart goes like this. NVIDIA, whatever you want. It may be more like this than this, but you get the idea. There's huge pullbacks. And the truth is, most of the time, if you did some valuation work, that can help you get in the right range, kind of on the chart, so to speak. But overall, did the companies outcomes like change massively as the chart. I mean, no, not really, probably not. And yet, if someone had bad luck and bought at one of those little peaks, they're depressed when it goes down. And if someone
Mhm.
got a little lucky and bought at the bottom of one of the troughs, they feel like a genius. Well, the decision making is the same,
Yep.
right? I mean, it's roughly the same. And yes, we can add some alpha, so to speak, by being very disciplined, like when we buy. But overall, if if company stocks just went like this, or maybe like Visa, for years Visa just kind of went like this, okay, fine. But there's a reason I
Sure.
said Visa. There aren't really any others. Pretty much every other one is very volatile, right?
That's
And
right.
it doesn't
Right.
mean you're wrong just because you didn't time it perfect.
Right. And perfect timing. Let's face it, it's mostly luck anyway.
100%.
Nobody has it.
Yeah.
Like we said at the beginning, you need a dose of humility when you do all that. You can't predict anything, but you can do the point is though, you can't predict anything, but you can do the fundamental work. You can absolutely learn to identify what is a really great business and what is not. And once you get the basics of that, they tend to hit you over the head. They call themselves out to you when you're looking at the fundamentals, when you're looking at the business, and when you're reading the filings, and when you're looking at the financials. It's like, okay, consistent margins, gushing cash, great balance sheet, raise the dividend every year for 50 years or something, whatever it is, right?
Something's
Whatever it
working.
is.
Hmm.
Yeah. All right. So I want to talk about high yield now.
Sure. Yeah.
Um, because we had Harley Bassman on the show, and he seamlessly talks about bonds and options. I mean, it's all kind of a flow for him. So it doesn't surprise me at all that you're the high yield guy and you're the options guy. Maybe that's a place to start. I hadn't planned on doing this, but why is that? Why do the bond guys know options so well? They all seem to.
Well, I haven't experienced that too much personally, but you would have a better view, Dan, than me
Oh, okay.
from your seat.
All right.
But it does make some sense where, I mean, you guys tell me, but I would say that really you could, if we dump all credit into a bucket, even though it's very, very different, it's
Uh-huh.
in the same bucket, isn't it? In most people's
It
mind,
is.
it's kind of all the same. It's
Mm-hmm.
not interesting. It's almost too complicated by how simple it is, where
Mm-hmm.
someone just sees a yield
Yeah.
and they go, I don't understand how this works. Like if the company does well, what happens? If it does poorly, well, nothing. But what if it does really poorly? Oh, you lose all your money, right? Like that's kind of
Yeah.
how it works in a nutshell.
Yeah.
Right.
And so I think they're both considered kind of abstract, and they both require. Um, I think it. I mean, you could. I think you could argue this at least. It takes a lot of due diligence just to find an opportunity. Equities aren't
Yep.
like that at all, right?
Right.
You can spend 2 minutes and find 100 interesting stock positions.
Yep.
I challenge you to find that in bond, right? The bonds can be tough,
Yeah.
especially individual bonds or ones that don't yield, 4% and just don't make sense for anyone. Just the truth is, right? Spending the time to find an individual bond that just pays kind of a quote normal amount, it's a waste of time. It's not very interesting. And yet the bond, the fixed income market's also a little illiquid. Things are not priced properly all the time. Some things are really priced well, but you go into kind of the bottom of investment grade. So think of quality companies, and you're at the bottom. So you're still a quality company, but you're at the bottom.
Mm-hmm.
And if you go much lower, now it's questionable, right? Whether you're a quality company. That area is not very effective, and the bond prices are pretty volatile, especially whenever there's a little bit of a crisis. And we've had a great investment opportunity the past few years where we had that regional banking crisis, right? The Silicon Valley component, any recession, and it causes, again, not like the highest rated bonds, but ones kind of in the middle and below, to
Mm-hmm.
become very volatile, and you get some great opportunities. Uh, yeah, but for me, high yield, and I probably don't define it like most people, is I'm including, preferreds, I'm including bonds, not treasuries or anything, generally speaking, but whatever, maybe bonds that yield more like 6 to 9 yield to maturity. So that just means including capital gains, to maturity, and then
Mm-hmm.
even some equities, believe it or not. So
Sure.
business development
Right.
company.
BDCs. That's what one I was thinking of, and like
Yeah,
REITs,
so
MLPs, maybe, or no.
yeah, it kind of it's pretty subjective, frankly. I definitely don't have a perfect definition, but yeah, if the yield hits kind of a benchmark, the total return kind of hits a benchmark, and the risk
Hmm.
is acceptable, then I kind of will include it. And the reason is the way that I look at it is, I was blessed to have a reasonably good understanding of these different asset classes that most people don't because I did it for my career for so long. So that means I try to look at all of them. I try to have a big responsible, but a big opportunity set, so I can try to find the most interesting, best risk just returns, for the customer. That's kind of how I look at it.
Okay, that makes sense to me. That
Yeah.
makes sense. What
Let's face it,
the
it
first?
takes some more work to do the bonds and and
Thank
options.
goodness
And
I enjoy it because it
yeah,
does.
Yeah.
Yeah, most of them result in nothing. So most of them I just spend hours, and then at the end, I'm like, yeah, this isn't as good as I thought it was, and so be it. You just move on to the next one.
Yeah, the bond option guys I know are all like you and Harley. It's like deep digging, scouring the market for opportunities that nobody else seems to be able to find, or most people can't find them.
Hmm.
That makes a lot of sense. But also, there's a math component in there too.
Right.
Um,
yeah.
uh, very very good math people are doing both things. It seems like anyway. This is a fetish of mine. I'll get off of it. But um, do you have? I mean, I feel like we need a concrete example. Like, do you have a name, like an equity or anything, or even just a company whose bonds you like right now that you can talk about? I know you have subscribers, and they probably don't want you giving away their latest, greatest stuff. But
Yeah.
is there a concrete example that we can use that kind of highlights your style and why it works for you?
Yeah, I can use some. So Brookfield is, I think it's the second largest alternative investment manager. So what that means in simple speak is you have like maybe a BlackRock, and you have these other firms that really focus on ETFs and mutual funds, Vanguard, for
Hmm.
example. They don't
Yeah.
do a ton of alternative investments. That's more of like a Blackstone, right? Blackstone has the biggest
Oh,
real estate
Blackstone.
portfolio in the world, right? Stuff like that.
I was going to
Um,
say Macquarie, but Blackstone. Yeah.
yeah, they do a ton of consulting. McCoy does too. Blackstone, they're like strictly alternative investments, and Brookfield, I think, is the second largest, and they're actually a Canadian firm, and so they're pretty similar to Blackstone. They just have a little bit different approach. They're actually more heavy in infrastructure. That's kind of what they're known for. Is I think they're the world's largest owner of infrastructure. Think of dams, maybe hydroelectric facilities. That those kind of go in two categories, right? But they're like the largest infrastructure owner. Well, Brookfield, I don't know if it really helps the company. Those guys are probably way brighter than me, so I'm going to assume it does. But one of the things that they do is they financial engineer the heck out of their business. There's Brookfield Asset Management, right? There's like, I could probably list 10 of them off the top of my head. Well, each one of those entities ends up having its own capital structure in a way, meaning their own debt, equity, etc., in a way that Brookfield thinks is like optimal. A lot of firms don't do that. They just have like one company, and they want the lowest cost of capital. So, they do it. It almost like if, you have a teenage son, and you're like, you know what, actually, I'm going to make you get the loan because at least it's lower liability on me. But your interest rate's going to be double. A lot of people, the parents are like, nah, I'm paying for this anyways, right? I'm just going to consolidate it under me. It's a little bit like that. The difference is that in Brookfield, most of the bonds do have a parental guarantee. It's not the easiest to find. It's not always. It's actually pretty difficult to find, but not all of them, but most of them do. And because Brookfield is trying to optimize everything so much, they have entities in Bermuda. They have entities in Cayman Islands. They'll have a bond issuance in Canada. The same company has a bond in somewhere else, and those have no research. There's nothing out there, no coverage, and many of them are actually tradable bonds, meaning they have a ticker. They're like baby
Hmm.
bonds, is kind of what people call them. So
Hmm.
again, the financial engineering part, at least this one helps us, right? They made it where you can just trade it like your Fidelity account. Well, these
Yeah.
bonds are often very long term because they match the infrastructure. So it's an entity, it has a bunch of infrastructure, and the lifespan of the infrastructure is whatever, 30 or 40 years. So they
Hmm.
issue these bonds. Well, because nobody understands most of what I just said, right? Practically speaking, it sounds like gibberish, right?
Yeah,
Um,
it does.
yeah, because it kind of is. And what Brookfield does is so unusual. People just don't put these pieces together, and it's almost like, why doesn't Brookfield make this more evident? It would help them. But to give you an example of what happened is they issued some of these bonds on some of their infrastructure, uh, again, if you put Brookfield into a like whatever your search bar is on any financial services website, you actually see a bunch of bonds pop up, and you can go explore those. And a lot of them had current yields of between like 5 and 5.5. So not current; it's the wrong word for it. At par value. So when they issued the bonds, maybe they paid 5.25. Whoop de
Mm-hmm.
do. Right? Okay, fine. That's not bad, but whoop de do. Well, many of those, particularly when I recommend them to subscribers, and they're only a little bit above where that is now,
Mm-hmm.
um, they traded, at like 70 cents on the dollar, 65 cents on the dollar.
Now you're talking.
Now you're talking right. Now you can do a little arithmetic and you go, wait a second, that five now starts with a seven. But it's actually much better than that. That's the immediate kind of gratification is, wait a
Mm-hmm.
second, I would buy a bond. Now that I understand it, right? Steve and Dan Corey helped explain it to me that actually Brookfield is a guarantor all the way down.
Mm-hmm.
A seven handle, 7% yield on this bond is super great. It is great, but it's much, much better in the sense that if interest rates, almost win, but we'll say if interest rates over the next 5, 10 year, whatever, right, do come down a little, that bond is not going to trade at 70 cents or 65 cents on the dollar anymore. Now, I'm not saying it'll go to par necessarily, but it'll probably go to 80, maybe
Mm-hmm.
85. So that 7% yield may not even be the biggest return component. It may actually be the capital gains. And so
Mm-hmm.
that's a really interesting setup where it's not obvious when you see this bond and you see the price and you're thinking, this Bermuda bond, what the heck is this thing? But I love solving those puzzles and putting the pieces together. And eventually, in my opinion, what will happen is it will trade back to par, and then everyone will say how obvious it was. Oh yeah, I can't believe everyone didn't buy these. Didn't you know they're backed by Brookfield? But
Yeah.
since they're so discounted, I
Right.
think it makes people even more suspicious when that's really a discount just due to interest rates. It's nothing to do with Brookfield or the infrastructure. It's what we talked about at the very beginning, is that they're just trying to discount things and make it work for inflation. But I'll tell you, if you just own that, it just pays you 7% till the bond matures, which by the way, it has to go to par when the bond matures anyways. But that's
Yeah.
that's not
Right.
a terrible setup.
Right. Yeah. Oh, yeah.
Yeah.
It's you've just described one of the beauties of high yield. You get a nice capital gain plus a great yield. You get paid. I remember. I'm trying to think. I knew Brookfield. I knew Brookfield way back when. Before it was an asset manager. I've recommended too many stocks in extreme value since 2002, so I probably can't find it here in the list. But I know I covered it at least once um, when it was BAM, Brookfield Asset
Uh-huh.
Management.
Yeah, before I went to BN and the different ones now. Yeah.
Right. And then, but I knew it before it was BAM even. When it was before it was Brookfield Asset Management. Anyway, what they've done though, like you're right. If you go to if our listener just goes to Yahoo Finance or whatever, Google, whatever it likes, just type the word Brookfield and 10 tickers come up.
Yeah, it's overwhelming. Yeah, it's like
Yeah.
I don't. And the funniest part to me is that and again, I'm grateful for this. They made a lot of them baby bonds, so like you can actually go buy them in $20, literally $20 increments if you want,
Yep.
which is
Like preferred
extraordinary.
stock or something. Yeah.
It's great, and
Right.
you tend to get less slippage too when you buy the bond. They're not as illiquid. You put the limit order, and it works great. So it's clearly retail focused, but
Mm-hmm.
nobody knows about them. They're too complicated. I mean, Brookfield Infrastructure Partners, that's one you've probably seen, Dan, BIP. They're the biggest infrastructure
Yep.
owner as an individual
Oh yeah.
entity. And they
Yeah.
have like four different bonds from four different countries. And, it's all the same parent. Um, but who's going to figure, I mean, really, who's going to figure that out? They're going to see a
Yeah.
7% yield and, again, totally justified, probably say, too good to be true. I'm missing something here. I'm going to go on to something else.
Right. Yeah. Have you ever met Bruce Flatt
I
from
don't think so.
Brookfield?
Mm-mm.
Yeah. I met him a couple times years and years ago, like at grants conferences and stuff. And I thought, here's this guy running this massive thing. And I just walked right up to him, started talking to him for 10 or 15 minutes. He's like the most sort of down to earth. Well, he's Canadian, so he's polite as
A
hell,
little more
right?
friendly. Yeah.
Um,
There we go.
uh,
Yeah.
um, and approachable. Um, but yeah, I just thought, God, this guy is like I'm looking around the room. He's like the bloody genius, like I don't mean this in a derogatory way, but like the paper hanging genius of of Canadian markets and And here he is, and he just seemed like the most, down to earth guy. And I'm like, God, they're running this giant complex thing. It's when you read their filings and you get into all this, it's not easy to work it all out, is it?
Not even close. No, the Brookfield
Yeah,
one, whenever
it's
I've done, uh, really, I mean, everything I do has a strong education component. I think I hope at least that's the most valuable thing I actually provide. Not that I don't want the investments to work out. You guys have heard how much work I put into them, but
yeah,
teaching the person I think is the most important because that's going to help their decision making, hopefully the next 20,
right.
30, 40 years. But I
The
use
thing is,
Brookfield. Oh, go
go
ahead,
ahead.
Dan.
I'm sorry. It just the what our this is for our listeners' sake here, Stephen. Nobody thinks about just identifying the equity pieces and the debt pieces. Like
Right.
you just and then ownership stakes in all of the other tickers and stuff. You and just working out the capital structure and those ownership stakes is like that's real work for a company like Brookfield. Anyway, I'm sorry I interrupted you,
No,
but
no, you're good. It was actually really in line with what I was going to mention is that I've done some strictly educational pieces occasionally, just as a kind of a freebie for our hardworking newsletter subscribers, and I've often used Brookfield to explain the concept you just mentioned, Dan, about you know okay, well, Brookfield, this I'll keep it simple but still effective. Brookfield entity one has equity, preferred, and debt. Which is the best? Well, there's no best, right? Not really. But if you walk through the pros and cons of them, you can often find that it would, I think you mentioned this before, Corey, like it'll jump out to you as, no, this is the best for me because my priority is maybe capital preservation, and maximizing my yield. So actually, why the heck would I ever do the equity if I can get the preferred that pays the same, maybe even more, right? Or the bonds. And on the BDC subject, Dan, uh, in the high yield advisor, we still have, they're almost back to par now, so we won't be in them for much longer. I think they mature next year. But we bought some bonds during whatever that crisis was, maybe like 2 to 3 years ago when the high yield sold off. We picked up yield and maturity bonds on investment grade BDCs for like 7 to 8, 7 to 8, 8 and change. Some of them were 8 and change. And then the equity, it yielded higher. Do not get me wrong, right? It was yielding kind of normal BDC 10 to 11. But to me, risk adjusted for the average person, an 8.5 on investment grade credit, where it's never going to change. And realistically, it's not going to change your portfolio. It's just going to go like this, through 2026 versus BDCs, which are very volatile. They're primarily, retail investor owned. I laid it out, and of course these are just suggestions for people, but I was like, this doesn't happen often, right? When the bond gets this close to the equity, I try to take notice because often it's a great opportunity, and then they'll correct, right? Like pretty soon it'll go back, like, oh, I'm not interested in the debt anymore because it yields 5. It's like, well, yeah, now you're not, of course. It's too far off the common equity.
right.
I know you're talking bonds mostly here, but I'm going to briefly try to take this into what one thing you mentioned before, the highly leveraged like crypto, right?
Okay.
There's these super high yielding, products out there now, like 30% yields, and whatnot. And you talk about your hedge fund or your hedge fund days and kind of examining all these, where does the yield come from? What do you make of, not
Yeah.
necessarily like a micro strategy, but like there's like
Yeah.
there's dozens of them now. What do you make of, like, what should people look out for when they see like these double digit yields and things like that?
Yeah, well, it's funny as a reminder because I saw those a couple of news articles pop up on those exact funds you're talking about, Corey, and I have not dug into them very deeply, so I won't
Okay.
pretend like I have. But I can talk in generalities that will probably just lead us to the same conclusion. Um, the reason that I spend all that time on that Brookfield, right, weeks maybe trying to figure it out, is because
Mhm.
if you don't understand where the number comes from, whether it's a 7 or 8% or whether it's a 30%, there's a good chance it's not going to work out for you. you just there's too many things going on that you're not aware of, kind of by definition, right? That can cause you problems. And when you don't know what you're doing, and this applies to me as much as it applies to anyone, when that thing that you paid $1,000 for goes to 700, then 600, your pain is going to go up, and you're going to hit a breaking point, and you're going to
Yeah.
sell. You're not going to sell near the bottom. It'll probably be like the print. It'll be right at the bottom, perfectly timed, because you
Right.
and the other guys are all in the same boat, right?
Yeah.
Because you don't really know what's happening. All you know is it's supposed to go up and it's going down. So anything with a double-digit yield that's just definitely a shortcut. Anything with double-digit yield, you should look at very closely. And I've recommended stuff with 10 to 11% yields. It doesn't mean that it's a terrible investment or anything, but you got to look at it very, very carefully. And then I do think it's safe to say there are certain sectors. Crypto is probably the easiest one to kind of not attack here, but highlight, where it's very retail focused. People are getting a lot of money when they make up some goofy idea, right? They come out with a new fund. You mentioned there's like 15 of them. There's not 15
Yeah.
of them because there's 200 grand in each one. It's probably because there's 10 or 20 million dollars in each one. And these guys, if they can come up with a strategy to make a lot of fee income off you, they will.
Yeah.
They don't have any responsibility to like make you do a test that you understand they're offering. There is in the private world, by the way. In the private world, there's a lot of paperwork and there's some restrictions. But when it
Yeah.
comes to stocks, for better or worse, right, you can buy whatever you want. So I definitely recommend trading very cautiously. And if you can't explain to your spouse or good friend how the 30% yield like comes from, that's a good warning sign.
Yeah,
Yeah.
goofy is a polite way of saying crazy bullshit, I think. And so, because
Yeah,
I don't,
very true.
I thought, oh, Steven's going to tell me where the yield comes from because Corey was framing his question that way, and I was, oh, okay, he doesn't know either. No, but I can't get anybody to tell me what is the real true source of those yields. And that could be a shortcoming of mine. I don't say that it isn't, but I think it's it's interesting that we can identify the source of yields in preferreds and equities and
I'll
high
tell
yield
you too that
bonds, and we can't identify the crypto yields.
yeah,
So,
well, I'll tell you too
Yeah.
that again, being totally transparent does not necessarily apply to those. It probably does, Corey, to the ones you asked about in crypto, but I don't know for sure. Is that the number one way is return of capital. So there's a
mhm,
lot of high yield plays I've had people send me over the years that yield maybe close to 20, and
mhm,
a lot of it's a return of capital. So you put in $100, they're literally sending you back $1 or $2 a month on top of whatever it earned, and they're allowed to do that. By the way, they just have to disclose it. So you
yeah,
can guess where the stock price is probably going to go if they're just literally giving you your money back as a yield. And then the
right.
second most common is derivatives. So they're using derivatives, taking on one type of risk or another, or maybe multiple. And then that's the other way they're kind of engineering the high yield. And both of those work out the same way your gut instinct is telling you right now, usually.
Yeah. All right. This is a good place to ask our final question. Um, our final question is the same question for every guest, no matter what the topic, even if it's a non-financial topic. If you've already said the answer to it, feel free to repeat it.
Hmm.
Um, but the financial question is for our listeners' sake. If you could leave them with one takeaway or one thought today, and like I said, if you've already said it, that's cool. You can just repeat it. One thought, one takeaway today. What would you like it to be?
Well, I'll give them like, maybe a little challenge, maybe a little growth opportunity.
All
I would
right.
say that odds are one of the topics that we've talked about today is a little newer to them.
Mm-hmm.
And I would say my suggestion would be to go research one of these areas and just kind of learn as much as you can about it. And maybe from you can go back in the podcast and hopefully I've given you maybe a few things kind of what to look for. But I would just encourage you to go explore these different parts of high yield, maybe explore options for the first time, not even
Mm-hmm.
necessarily risk any money, but just go explore them. Because the truth is, a long time ago, I didn't know about any of these sectors. And I started as a teenager, like 14, 15, investing in little stocks. And I wish I held my $200 in Apple and I didn't. I sold like a chump. I like doubled the money, 20 years ago, whatever. But the point is, you can find people that will help guide you as you get, more into it. I also had great teachers, as a due diligence officer for many years. But that would be my suggestion is go find one of these that sounds interesting to you, put some time and energy into it. And then who knows, maybe that really helps your portfolio and your investing, long term.
Nicely said. Thank you for that. And thanks for being here, man. It was really great to talk with you.
Yeah, greatly appreciate the invite. You guys had great questions, and if you want to have me back, I'm happy to help.
Oh yeah,
Yeah,
I'm already thinking of questions for having you back, you know. We'll
Excellent.
talk
I'll
about
look forward to
yeah,
it.
yeah. All right. Thanks a lot, man.
You're very welcome.
Hey, I like that guy. I like me some options and I like me some high yield. That was cool. I could have done another 2 hours of that, really, honestly. It was great.
yeah, you definitely could just go exploring, you know, income generation,
Yeah.
which is on the mind of a lot of people right now,
Hmm.
within the last 5 years specifically. I'm thinking of just like inflation and people trying to keep up with higher prices and everything. And we have
Yeah.
we have similar products, in terms of the put selling. It's at Stansberry for a reason. Like it's something, if you know what you're doing and you do it on stocks that you are comfortable owning in the long term, like we were talking about.
Yeah.
It's if you're like looking for income, it's kind of a no brainer to do to do it. I mean,
Yeah.
if you have enough capital to put to work. Um,
Right.
so yeah, and then high yield, um, opportunities. Yeah, it's really that, like you were saying, like that math calculus about finding like what's being overlooked here in the market, and who's, and a lot of times it's on the just stuff that most people aren't looking at, right? And like that's where you
Yeah.
find the opportunity, if you just like do some work, if you have the time to do it, which not everybody
Right.
does, and then you go find someone like Steven who can do it for you. So
Yeah. And you mentioned, people concerned with income. I would go back farther than the last few years. I would go back
oh
to
yeah,
taking the Fed taking interest rates to zero and everybody going, I can't own bonds anymore. Now what the hell do I do? And
right,
the answer is absolutely options, selling options. And we had another guest on the show, Mike Green, who their corporate mission seems to be very close to taking all the complex option strategies out of big institutions and offering them in the form of retail ETFs. Some of which you may be interested in, some of which you're not. It's not a recommendation, although I have recommended one of them, which I mentioned before when we had Harley on, and I recommended his mortgage um, ETF because he buys recent vintage mortgages, which yield 6% instead of the older ones, which are like 3%. So, but yeah, Steven's focus in those two areas is very cool. And I didn't know about him. I didn't know he was under the MarketWise banner. So he's
yeah,
going to be like my new he's going to be the new guy under MarketWise that I'm fascinated with now. I want to read everything. I want to read all the option stuff. I want to read all the high yield stuff. And knowing that he focuses on the fundamentals of the business, he's not just like a trader. That to me is gold. That's where you get real conviction, and those people they're the ones I want to know about, the people who understand the business and then structure the trade. So anyway, that was awesome. That was a fun interview and a fun episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we really truly did.